fundsupermart.com.
Hello everyone, with us today is Guan Yi, Fund Manager at Eastspring Investments. She will share with us her views on the Asian local bond markets. When it comes to Asian bonds, what are the advantages and disadvantages of investing in local currency bonds versus hard currency bonds?
Okay, well, Asian local currency bonds are a more effective way to diversify away from the developed markets. You see, when you buy a US dollar bond, the return will still be linked to US fiscal and monetary policies. US fiscal policy, the fiscal deficit right now stands at 10%, and there's no credible plan to bring it down. Because of the very high unemployment rate in the US, interest rates are going to remain low for a very protected period. Now, both are going to be negative for the US dollar. Whereas Asian local currencies are more closely linked to the Asian growth profile. And Asia is expected to grow at a faster rate than the rest of the world. So this is going to be positive for Asian local currencies, and hence the bonds. The main disadvantage, Asia local currency bond markets are not that accessible. In India, for example, you need to bid for a bond quota before you can invest in a bond market. However, our fund has been actively invested in these markets over the years, so we are well positioned to navigate the complexities. India, for example, we have been directly invested since 2010.
Some investors are concerned about the risks of sovereign bonds due to the European debt crisis. So why is Asian local currency bond a better alternative? Well,
Asia is in a very different position. Our debt to GDP ratio stands at below 60%, whereas in some European countries it's over 100%, and I think in some cases 200%. So debt, the quantum of debt is not an issue for us. And in fact, it's going to improve over the years given our very strong growth outlook. Okay? And because the debt quantum is not as big a burden, the Asian central banks are able to pursue inflation-targeting monetary policies. There is no question of Asia trying to inflate its debt away or keeping currencies weak so as to reduce the debt burden.
In particular, which countries and sectors do you favor now?
For the bond market, we are most positive on Philippines. Fiscal deficit is going to fall below 4%. Inflation has fallen below 4%, yet the 10-year bond yield is at 5% and represents very good value. The Philippine Central Bank has cut interest rate once this year. We think it will cut another time, and that again is going to provide a boost for the bond market. In currencies, we are most positive on the Malaysian Ringgit. We think the worst of the global trade slowdown is behind us, and Malaysia typically has benefited from a very strong current account surplus. And the current rising trend in oil prices is especially positive for the Malaysian Ringgit. Away from the government bonds, we also like the Asian local currency corporate bonds because of the very positive debt profile of our corporates, which we expect to improve in the years ahead.
What kind of returns are Asian bonds offering currently?
The running yield is about 4%. We expect currencies to appreciate by 2 to 3% this year. So in total, we expect a 6 to 7% return from Asian local currency bonds this year.
What about the major risk factors?
I think near term, the biggest risk factor still remains to be the European debt crisis. Should the European countries fail to contain the debt situation, there's a real risk that the European financial system will not be able to handle the losses because they hold so much European government bonds. If that were to happen, it will be a destabilizing event, not just for Europe, but for the global financial system. Now, in such a situation, right, Asia cannot remain immune. Okay? However, I have to qualify that this is not our base case scenario. This is a tail event for us. And if this tail event should come to pass, Asia, having run up FX reserves to record levels since 2008, is in a position to try to mitigate the effects. Last year, for example, we saw the Asian central banks provide liquidity in the market, supporting the bond market, supporting the currencies, and we expect the same kind of policy action to be taken should the need arise.
Thank you.
Thank you.